Hey traders, Akil Stokes here. Welcome back to the Trading Coach Podcast. Today we are going to talk about fixed risk. Now, today I want to I want to discuss an article that I recently read on the Trader Vault page, right? I haven't talked about it much, but if you go to thetradervault.com, it's a little website we have that, kind of takes different articles and talks about them kind of short, quick, to the point, very remedial and dummy proof, which is my style. So make sure you check it out. And the article over there that I read today was, actually read it a little bit ago, but I reread it today. I bookmarked it a little bit ago. It was called Risk and Reward in Trading, Navigating the Low and High Risk Strategies. And we're not going to read the whole thing. You can read that over on the website. But I wanted to talk a little bit specifically about fixed risk. And before we hop into that, let's talk about risk in the first place, right? For you guys that are new, you're probably asking yourself, what is risk, right? Trading is just looking on a chart, reading the news, finding opportunities, and making lots of money. And wrong, right? There is a very powerful lesson that I learned very early on in my trading career. And I had the luxury of talking to some of the greatest traders out there of my time and kind of just, sponging information off of them. That's one of the reasons I do so much for free now. That's one of the reasons that I started my trading blog all those years back. That's one of the reasons I put out all those short videos giving you kind of trading tips. That's the reason I started the Trading Coach Podcast, to kind of be an outlet as a veteran trader that newer traders or aspiring traders, even veteran traders that just want to hear more trading talk, can come to and kind of get some wisdom. And one of the greatest bits of information that I heard was this quote: good traders are great risk managers. And this puts into perspective how important risk management is to a trader. It's going to be very, very hard to be successful without taking proper risk management, right? Risk management is the ability to control your losses and the actual monetary amount of how much you lose when you do lose. Now, some of you guys are probably out there saying, well, Akil, it doesn't matter if I have like a 90% win percentage, risk management doesn't matter. And wrong, right? It still matters, right? Yet I remind you of the story of the 90% trader. I told it a while back. In fact, I have another podcast that I never released on it. Maybe I'll put it in again right after this one. But the story of the 90% trader, basically a trader wanted to be 90, close to 100% in his win percentage. He did that and still lost money. So even if you are winning at that high of a hit, you still have to have proper risk management to control those losses, right? So there are different types of risk management tactics. The one we're going to talk about today is going to be your fixed risk. Now, before we get into it, I want to read some of the blurbs here from the article that talked about why risk management is important and kind of the pros and the cons of the fixed risk management. So first of all, just talking about risk management from a general perspective. Sorry, the words are slurring. Just literally got back from a bike ride. Did not fuel myself yet, so I'm kind of hungry, kind of fatigued. But one is capital preservation, right? Risk management ensures that traders can stay in the game longer by preventing substantial losses that could deplete their trading account. Pretty straightforward, right? The less you lose, the longer you can stay in the game. In trading, it's all about having a chip and a chair, right? The thing is this about trading, right? We don't know when wins are coming. We don't know when losses are coming. I started trading in the year 2007, and I can tell you that each year is a little bit different. I've had hot starts to the year. I've had cold starts to the year. I've had hot end to the year. I've had cold ends to the year. I've had hot middles. I've had cold middles, right? I don't know when hot streaks and cold streaks are coming. So therefore, I just have to survive long enough to make it to that next hot streak. And if I'm not taking proper risk management tactics, I'm going to blow my account before I have a chance to do so, right? Next is emotional control, right? It helps in managing the emotional aspect of trading by having a clear risk parameter, thus avoiding impulsive decisions driven by fear or greed, right? We know that fear or greed are the two main demons on our trading shoulders here, and they're going to influence a lot of what we do. I don't think risk management takes them completely out of the equation. It's a handful of other things that you have to do and put them all together, but it helps to know how much you're risking. Another gem that I was told when I was younger as a trader was that you should trade so small that your losses don't hurt you and your wins don't really get you excited. When I first started trading, I was trading so large that whenever I would win, it was like, man, this is a change in my lifestyle. Like, I hit the jackpot. I'm going to go do this. I'm going to go buy a car, right? And then I'd come back a day later and I would lose so much that I'd be devastated and depressed and never want to trade again. When you trade very, very, very small and you understand what you have at risk, it kind of puts everything in perspective. For example, like, I was just thinking about this the other day. I don't know why. So as a young kid, right, I'm from Philadelphia, PA, not the greatest place in the world. As a young kid, I got robbed at gunpoint once, right? I was walking to the CD store after school to buy some CD. I think it was a Kid Capri mixtape that came out, and I was all excited. I had all my, I had my allowance and blah blah blah. I was gonna go buy the record, and I was taught this at a very young age, to always keep kind of bills in separate pockets, right? So I had like my ones in one pocket, I had like my 20 or whatever it was. I didn't have a lot of money on me, but in the other pocket. And, I was walking to the store, my spidey senses went off. I felt someone following me. I did the whole thing, crossing the street, blah, blah, blah. Went into the store, thought I avoided him because I figured that he would give up once I'm in this crowded place. Went and got the CD, came outside the store, was waiting for me, bada boom, bada bing, right? So I'm getting robbed in this alleyway, and the guy's asking for my money. And I remember I didn't panic. Right? I'm just such a cool dude, right? No, but I wasn't panicking because I had already bought the album, and because I was a kid, didn't have a lot of money on me in the first place. I only had about like $10 in my pocket. So when he robbed me, I'm just like, hey, here, take the 10. And I went on and went to, I think, play a basketball game after that. It wasn't a big deal. Never talked about it. Probably why I have some trauma and trust issues and paranoia to this day. Now that I think about it, that's probably when it all started. See, these podcasts are good for me as well. But the fact was, I knew coming out the store that there was still a chance of me getting robbed. And I wasn't thinking like I was going to get killed or something like that, because back then people didn't like recklessly kill people as much as it seems like they do right now. They just want your money. So I was okay giving up $10 because it wasn't that big of a deal. Like I didn't, I was, again, probably traumatized for the rest of my life. But from a monetary perspective, it wasn't that big of a deal. So the same thing is with trading, right? Entering a trade is a very scary thing. And a lot of our decisions are dictated by emotions, right? A lot of it is fear. We don't want to lose money, or we don't want to lose too much money. If you go into a trade and you know how much that you're going to lose already, risk management tactic, then you've kind of already made peace with that, and it's okay. The next one is consistent strategy application, right? This facilitates a consistent application of trading strategy and makes it easier to evaluate performance objectively over time. Yeah, consistency, right? Consistent analysis plus consistent execution equals consistent results. That's kind of my formula to success in trading. Consistent analysis is analyzing the charts, trading the setups that you're supposed to trade based on your trading plan. Consistent execution is actually pulling the trigger, but it's also money management as well, right? Consistent execution. Are you using the proper position size? Are you trading too big? Are you trading too small, right? If you're consistent with it, you get consistent results with what you're doing, and those consistent results should mimic your backtesting results, and your backtesting results should be profitable if you're trading live in the first place. Compound gains is next, right? This protects profits by minimizing losses and allowing traders to benefit from the power of compounding over time. Again, less is more addition by subtraction. The less you lose, the more you make. Trading is all about compounding, right? It's not about this super jackpot win. It's about doing the small, dirty work day in, day out, time over time. And that money slowly grows and grows and grows and grows. The cool thing is, right, if you remember the podcast we did on compounding, right, after about 5 years, that slow, boring, consistent growth, boom, shoots up, and that J curve really starts to take off. And conservation of capital is key. You're not going to make it to that 5-year mark if you're just kind of going up and down and ending in the middle place, or even worse, ending in the negative. So you want to control your capital so you keep more of it. The more you keep, the faster you can accelerate it. The faster you can accelerate it, the wealthier you're going to become. Next is market adaptability. Allows traders to adjust their risk exposure based on changing market conditions or volatility, providing flexibility to navigate different trading environments, right? We talked about changing market conditions in a recent podcast. We spoke about everything in a recent podcast. Man, I guess when you have almost 1,000 episodes, you're going to speak about a lot of things. But yeah, you can change this situationally, right? If you're in a hot streak, you can reduce your risk. There are methods, the martingale method, which I'm not a personal fan on, but there's a martingale and reverse martingale where you either decrease your position size as you're on a hot streak because you're preparing for losses, or increase your position size while you're on a hot streak to take advantage of it, and then vice versa for losses, right? So you can do that. You can adapt it to the volatility in the market as well. Now, let's take a look at the pros and cons of specifically kind of a fixed rate risk management. And a fixed risk management is trading or risking the same amount each time, right? So it's not like, hey, one time today I'm in the market, I'm gonna risk 20%, but tomorrow I'm gonna risk 5%. It's saying that, hey, I'm gonna risk 1% on every single trade, and usually 1 to 3% is the kind of the average, right? 1 is on the more conservative end, 3 is probably the most aggressive you'll see professional traders get. Either risking that same amount or risking somewhere in that range. So me personally, I don't use a fixed risk management tactic, right? I use a smooth ratio one, which is a little bit different, but within that, I have a fixed rate, meaning I can never risk more than 2% on a trade, no matter what. So sometimes the risk may be 2, sometimes it may be 1.5, sometimes it may be 1, depending on the uniqueness of the trade, but it's always within this range. So pros and cons, right? Start with the pros first. Enhanced risk management. This provides a structured approach to managing risk, which is essential to a long-term trading success, right? Again, you need to be a good risk manager if you want to be a great trader. We spoke about that earlier. Next, improved decision making. By having a clear risk strategy, traders can take more rational decisions, focusing on the trade setup rather than the potential of profit or loss. Knowing what you're risking or what you're potentially to make before the trade happens clears up the rest of the trade. You're no longer looking at the trade as this is the big win, or oh, this could be the big loss, right? You already know what it is because you have your risk management intact. You've measured your potential profits. You measured your potential risk. You know exactly what's risked. You know exactly what can be made. You've accepted that fact. You're okay with it. Now you can focus on finding good opportunities, right? Because you're not going to have those big variations, especially on the risk side of things. You're not going to have those big variations in risk. You don't have to worry about, oh my gosh, is this going to be the 20% risk? No, it's always going to be the 1%. Why? Because my risk is always 1%, no matter how far or close it is, right? So it gives you kind of that comfort zone of knowing that, hey, this is always going to be this. Let me focus my attention on something else. Increased longevity limits the impact of any single trade on the overall portfolio, increasing traders' longevity in the market, right? One trade cannot make a trader. One trade can certainly break a trader if you're doing it the wrong way. I've seen this so many times where traders have emailed me and sent me messages saying, Akil, I had 2 months of great profit making in the market. I'm like, yeah, dude, whoop, whoop, raise the roof, let's go, right? And then they're like, I'm like, I should have finished reading the email. They're like, yeah, but I lost it all last week. I'm like, how? I got greedy. I increased my position size and I moved stops back. I was getting closer to me because I was afraid of getting stopped out. And I blew 20% on one trade. I'm like, oh, right? You don't want to do that, right? The fact of the matter is, if you take one loss and you have a 1% risk, guess how much it's going to be? It's always going to be 1%, right? This is something I do on occasion with traders is, we talk about going broke and how I never have a fear of going broke in the market, and they can't believe it. And they ask, why is that? Well, I know what I risk per trade, right? And you can do your calculations where in order to go broke, you would need to lose this many trades in a row. When you look at it, you're like, man, I would have to lose like 50 trades in a row to go broke, or 100 trades in a row. For me, it's 200 to go broke. And you realize like, man, that's never going to happen. It kind of puts things in perspective and gives you more confidence about what's happening. So it allows you to stay in the game longer, chip in the chair. You can ride out those cold streaks and survive to the next hot streak. Stress reduction kind of goes hand in hand with what I just mentioned, right? Knowing the maximum loss beforehand can reduce stress and anxiety associated with trading. Kind of just spoke about that. And then objective performance evaluation enables traders to evaluate their trading performance based on a strategy and risk management rather than random outcome, right? We dig deep into the numbers here at Tier 1 Trading. All traders do, or should at least. when you know your numbers, when you know your odds, your probabilities, your averages, it's very easy to predict future outcomes. It's no different than a business, right? You know, McDonald's just doesn't wake up one day and be like, I wonder if this new location is going to be profitable. No, they have all the numbers beforehand, and that's how most franchises are, all the numbers beforehand. That's why you have to do things a certain way, in a certain order, be at a certain location in order to gain access or to purchase that franchise, because they essentially want to put you in a situation where you cannot fail, and the numbers dictate that, not you, the owner. Now, some of the cons. Missed opportunities, right? A strict risk percentage might lead to missing out on potential lucrative trades if that risk cap is reached. I dealt with this a lot more so in my early trading, but still now, where I had to cut a few pairs out of my portfolio because at the time, this is when there was a lot more volatility in the market. At the time, the risk needed to be involved in that trade was higher than what I was comfortable with. So there were trades where I'm like, man, that's a good one, but I just can't do it. It's too risky. And it kind of stinks, right? Now you realize you're doing it for protective purposes, and bigger picture, it's the right decision, because one trade shall not make you, but one trade can break you. But at the time it stinks, especially if it wins, because you're like, man, I knew I should have been in there and I have to sit on the sideline. So it kind of stinks. Overcomplication. For some traders, consistently calculating risk percentage for each trade can overcomplicate the trading process. This is true. This one's a little bit difficult depending on how strict you want to be. Again, I have the fortune of having this range that I can operate in between 1 and 2, so I don't need to be exactly to the penny. But if you're someone that's exactly to the penny and you need to have a 1% risk, there's a lot of math that goes in there. It's not just calculating the pips or ticks that are needed to take the trade and then seeing what percentage of that account equates to from a monetary standard. But if you're trading Forex, you got to do some calculations as well, because if you're trading an off pair like the pound yen, then you got to convert dollars to pounds, and then it goes all back and forth and then convert it back, and it's a whole weird thing. Now, there are some risk calculators out there as well, but a solution to this is like not being super strict. Have that range between 1 and 2. Don't be so super strict in that kind of situation, or get a really good pip calculator and just have it in your favorite toolbox so you can click it right away and do it. False sense of security, relying solely on risk percentages without considering the quality of the trade or market conditions can lead to a false sense of security. Yeah, so this is a double-edged sword. We can get very, very comfortable with risk reward, and it's good where it's like, 1%, no, I can't go broke, yada, 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 yada. It's also a very easy excuse to make mistakes, where you see a trade that maybe doesn't meet your technical rules and you're not supposed to trade it, but you're like, you know what? It's only 1%, right? If I lose 1%, what's it gonna hurt, right? In the last podcast, we talked about the power, the dangers that come with mistakes when you're not supposed to do something, but you do it anyway, and then it makes it easier to do the next time, and now all of a sudden you've built a new habit of making mistakes. That's the trouble that can happen here. Although it's only 1%, not a big deal, it is a big deal when you start repeating that bad habit of taking bad trades just because. So you got to be very careful with that. Potential for smaller gains. Limiting risk also means potential gains are capped, with which might frustrate traders. Yeah, this is another big one too, where, it's cool to see a win. I had this situation when I was managing money. I was managing money for a high-level client. I was doing really, really, really good, knocking off 3% a month like I planned, like a machine, and it wasn't good enough. He was like, well, yeah, you're on this hot streak, you're doing 3% a month, but shouldn't you be making more out of these trades? I'm like, well, no, that's how much I should make, because I have to have my risk do this to make sure we don't, blow your $500,000 or $250,000. I didn't say that part, obviously, but I'm like, risk management comes first and the profits are the profits. He's like, well, yeah, but what if we just, risked more to make bigger profits? And, we did that, and I ended up losing like $30,000 in like a week, right? So it was a bad idea. But that's the danger, right? As traders, we often get greedy, right? Greed, fear. So when we're risking a small amount, it's helpful because a loss is like, that ain't nothing. But now a win, instead of getting that big home run win that we can brag about on social, we're like, yeah, it was a win, it was awesome, but like, man, I wish it was more, right? And that's a danger right there. Last is adaptation challenges, right? Newer volatile markets may require different risk management strategies, making fixed percentage risk less effective. Again, this one doesn't necessarily relate to me, but as markets change and volatility changes, it gets harder, right? We start seeing the ranges of the markets kind of contract and expand during different cycles, or right now we're kind of in a middle one, but we've seen some cycles where, let's say we have a very expanded cycle where the ATRs are high, right? It's going to lead to much bigger ranges and stop losses. That's going to mean a lower PIP amount, because the bigger the range, the more that 1% is, the less your position size is. So you may have this monster trade where you're like, oh man, it went 200 pips in my favor, and you only make a small amount of profit. So if you're stuck in that set way, you run the risk of, not making enough during those periods, or not being able to take trades during those periods, like I mentioned earlier, or the opposite, where now if you have a situation where the markets have a very low volatility, the ranges are very small, now all of a sudden, like 1% is a massive amount of money if it's like a 10 pip stop loss, but that's what's on the chart because the ranges have slowed down. So again, there's that balance there as well, where I think if you are going to do a fixed risk percentage, you do need to give yourself a little bit of flexibility over those kind of different market cycles. So that's a little bit on risk. Let me know your opinion on risk. What type of risk management strategy do you use? If you do use fix, where do you use fix? Are you a 1%? Are you a 3%? What is the cap? What is the minimum? Anything you want to share with our traders on risk management is key. And again, you can go to thetradervault.com to check out the full article. It's got some more and expands on some stuff. I actually put it in the show notes below that so you can check it out. Before you go, make sure you check out that YouTube Shorts channel. Hundreds and hundreds and hundreds of quick tip videos meant to help you progress along your path and your journey of becoming a consistently profitable trader, or remaining a consistently profitable trader. Also, if you have any questions or anything, leave them below, DM me, contact me however you can. I love turning them into podcasts. I love turning them into shorts. I love just talking about them through email or whatever. I just like talking trading. All right, until next time, plan to trade, trade to plan. Time for me to go refuel. Take care.